And this is really, really important. We want you to be able to have access to your dollars. It sounds like income is going to be important to you, and we'd love to hear that because we like our clients to take income. However, at the same time, we've talked about it before, we don't encourage you to put all your eggs into one basket. We want to work with you to the extent that you want us involved to help make sure that you've got some safety net and some emergency funds set up, some liquid cash, because the trade-off, if some of this sounds too good to be true, it is unless you understand some of the fine print. We put it here real big and bold. The cost of admission for doing this, the way that we can provide you safety, security, guarantee your principal, not expose you to any market losses, not take you underwater. The big thing that we can do and how we can get that done is the fact that we offset the risk. You don't take any risk. The trade-off for you not taking any risk and putting it onto the insurance company is liquidity. We're going to have some liquidity concerns for the next 8 years, 10 years, or 12 years, depending on which product variety is going to recommend for you. What that means is you still have access to your money, but with respect to the first 12 months, they're going to limit your withdrawals to no more than 5%. You could take more, but they're going to have some penalties, and we'll talk about what those are a little bit later in the presentation. But the first 12 months, you're limited to 5%. So what we don't want to do is overfund this. We just want to put dollars in that are going to be more for a long-term saving strategy, and at the same time, going to limit your cash flow at least the first year to 5%. But after that, it really opens up. You can go all the way up to 10% a year, starting in the second year and through the end of the commitment period, which is either going to be 8 years, 10 years, or 12 years. Now, I say commitment, and we'll show you what that means, but what that does is it kind of is a minimum commitment on your part that you're going to say, hey, you know what, I'm going to do this with the insurance company. It doesn't mean you have to go away after 8 years, 10 years, or 12 years. You can keep this the rest of your life, and we find that many of our clients choose to do that. After the 10-year commitment, you can come and go as you please. You can take out 100% of your money if you want to, all at no penalty, keep all the interest, anything you'd like to do. So that's really the trade-off in doing a plan like this. But at the same time, once we understand that, it's a really good trade-off to make sure we have the safety, security, and principal protection. Another thing we can do with this account, it's really unique to us, is we can offer a checkbook access and withdrawals if you like. Kind of a neat way if you want some instant cash coming out of the program. We just ask that you write no more than 2 checks a year. Really use it for an emergency or some mad money quickly. You can only write a check to yourself, and the check has to be greater than $500. So it's kind of a quick way to get some cash out. Otherwise, when you're looking at some income, we can use systematic withdrawals. In other words, send me $500 a month until I tell you to stop. We can set all of that up, and you can change your mind at any time. And Aviva will just zap those dollars into your checking or savings account any day of the month that you choose that you want that to come in as far as a systematic basis. So take income when you need it. Put it on right away if you want to, or let this grow and build for a number of years. It can help counsel you on what's really going to be the best way based on what you're trying to accomplish. To the extent that you put any IRAs, qualified monies, or any of your savings plans dollars into this type of an account, rest assured that anything that you're required to take out of the account by the IRS, we're certainly not going to assess any penalties on those dollars for using the account the way you're supposed to. So a couple other things here to the extent that it's important, and many of our clients like this peace of mind. We've got a confinement waiver and terminal illness waivers are both included at no additional cost to you on all of our contracts regardless of age. Now, what that means is after you own this contract for a period of 12 months, so after 1 year, should you be confined to a nursing home for 60 days or longer, and you're still within that surrender charge period or commitment period, we're going to give you 100% access to all of your money, all of the earnings, and there's no penalty. So it's terrible to say it's a great way out because it's a really bad condition. Obviously if you're in a nursing home, but it's nice to know we're not going to tie any strings, any future strings to the account, and you've got 100% liquidity. At the same time, God forbid you're diagnosed with a terminal illness and have 12 months or less to live. We've got you that protection in this account too. Should that happen, again, 100% of all your money is available to you, even within that commitment period. No penalty. Keep all the interest and do with it what you like. Once you own the policy, we can have you register here at vivausa.com to be able to track your annuity values 365 days a year. Next thing I kind of want to shift gears and talk about, and this is really important to most clients, is let's talk about wealth transfer. Let's talk about what happens when you die. This is the only fixed annuity available in the marketplace today that we can offer a 4% guaranteed minimum death benefit onto the account that we call the Family Endowment Rider. Now, what the Family Endowment Rider is, it's an additional guarantee, it's additional rider that comes with a fee, and we'll talk about those fees in a second. But what it does is it guarantees that your beneficiaries will receive no less than 4% compounded annually on your original deposit minus anything you might take out and spend along the way. We think that's real important, the power of compound interest and the growth on your dollars. There's a catch here. The catch is you have to die for it to have any value for your surviving spouse or for your beneficiaries. But it's kind of a good catch when you start to look at the dollars. In a worst case scenario, we don't know what the future is going to bring. Maybe we are in an economy where things just aren't going to grow for a while or grow that rapidly, or they're just going to bounce around 1 or 2% here for a few years, or maybe as many as 10 or 12 years. If that's the case, this is a really nice additional guarantee that means at least your beneficiaries will receive no less than that 4% compounded growth on the account. When it starts demonstrating how all these features might work to really build a plan that's going to make the most sense for you, don't be surprised if he recommends this. You know, better than 98% of our business nationally comes in with this Family Endowment Rider on there. There is a cost to it. That cost is 60 basis points. What that means in terms of percentages is it's just over half of. I'm sorry?
You said 60?
Yeah, 0.60. So it's just over half of 1%. A good way to look at this, and when we talk about any fees that might be on this account, our fees really work like spreads. And what a spread is a fee is generated only if there's growth in your account. So if there's no gain, there's no pain. One of the things that we like to say, it's kind of cute, is no makey, no takey. If we don't earn money for you in your account, we in no way, with any kind of fee or additional rider you might want to put on this account, we in no way are entitled to a fee. What that means is only if we grow money in your account can we generate any income, as far as fees. What that means is the fee cannot erode any of your growth or any of your principal that's in the account. So if you put in $100,000, it's always going to be worth $100,000. Worst case scenario, no matter how many riders, additional fees you might add on to the account. So we think that's pretty important. The next thing I want to talk about is really a backup plan, a backup rider that you can purchase onto the account.